In January 2021, some of the smartest money managers on Wall Street watched their losses grow from $2 billion to $20 billion, and they could have stopped it at any point. They had multiple exit opportunities, but they didn't take them. This wasn't about missing information. It was about a psychological bias so powerful that it turns rational investors into gamblers who can't walk away from the table. Here's a simple question. Would you take a bet where you flip a coin, and if it's heads, you win $50, but if it's tails, you lose $50? Most people say no. And that seems reasonable, right? It's a fair coin. Equal odds. But here's what's interesting. Researchers have found you need to offer people about $100 on the win side before they'll risk losing $50. That's loss aversion. The psychological principle that losses feel roughly twice as painful as equivalent gains feel pleasurable. Daniel Kahneman and Amos Tversky discovered this in the 1970s, and it became a cornerstone of prospect theory, the work that eventually won Kahneman the Nobel Prize in economics. Think about your own behavior. You find 20 pounds on the street? That's nice. You feel good for maybe an hour. You lose 20 pounds from your wallet? That bothers you for days. Same amount. Completely different emotional weight. This asymmetry isn't a personality flaw. It's hardwired into how we process risk. But here's the problem. Loss aversion doesn't just make you sad about losing money. It makes you do irrational things to avoid admitting a loss has happened. You hold losing stocks longer than winning ones. You throw good money after bad. You reject reasonable compromises because accepting them means accepting you were wrong. And when you're managing billions of dollars, when you've built your entire reputation on being smarter than everyone else, when your clients expect you to beat the market year after year, that's when loss aversion stops being a curiosity and becomes a catastrophe. Morgan Housel puts it perfectly in The Psychology of Money when he writes that financial decisions aren't made in spreadsheets, they're made at the dinner table, in hospital rooms, during moments of fear and greed. The math might be clear, but the psychology almost never is. GameStop in 2020 was, by most analyst standards, a dying company. A mall-based video game retailer in an era when everyone downloads games digitally. Revenue had been declining for years. The pandemic accelerated the shift away from physical retail. Multiple locations were closing. So when hedge funds like Melvin Capital Management started shorting GameStop stock, it seemed like an obvious play. Shorting, for those unfamiliar, means you borrow shares, sell them immediately, then hope to buy them back later at a lower price, and pocket the difference. If the stock goes from $40 to $20, you make $20 per share. By late 2020, GameStop was one of the most heavily shorted stocks in the entire market. Short interest was over 100% of the float, meaning hedge funds had borrowed and sold more shares than were actually available for regular trading. Melvin Capital, founded by Gabe Plotkin, a protege of legendary investor Steve Cohen, had a massive short position. Other firms, like Citron Research, publicly announced their shorts and confidently predicted the stock would fall. In early January 2021, GameStop was trading around $17. The thesis was simple. Wait for it to drift down to single digits. Cover the shorts. Book the profit. But then something unexpected happened. A community on Reddit called Wall Street Bets noticed the extreme short interest. They realized that if enough people bought GameStop shares and held them, they could force a short squeeze. See, when you short a stock and it starts going up instead of down, you face theoretically unlimited losses. The stock can only fall to zero, but it can rise indefinitely. And if you've borrowed shares, at some point you have to buy them back to return them. By mid-January, GameStop had doubled to $40. The hedge funds were now sitting on paper losses. Uncomfortable losses. But here's where loss aversion kicked in with devastating force. To close their positions, they'd have to buy back millions of shares at prices far higher than where they'd shorted. That would mean accepting real, concrete, humiliating losses. So instead of cutting losses at $40, they held on. Some even doubled down, shorting more shares, convinced the fundamentals would eventually matter, and the price would crash back down. There's a famous experiment in behavioral economics where researchers gave people shares in a hypothetical company. One group was told their shares had increased in value. Another group was told their shares had decreased. Then both groups were given the option to sell or hold. The people with gains sold relatively quickly, but the people with losses held on significantly longer, hoping to get back to break even. They weren't optimizing for profit anymore. They were optimizing to avoid the psychological pain of realizing a loss. Richard Thaler, who won the Nobel Prize in Economics in 2017 for his work in behavioral economics, documented this pattern extensively. He called it the disposition effect. Investors hold losing positions too long and sell winning positions too quickly. It's the exact opposite of what rational profit maximization would suggest. And it's exactly what happened with GameStop. By January 20th, the stock hit $43, then $65, then $76. With each jump, the hedge funds faced a brutal decision: close now and accept a massive loss? Or wait, hoping this retail investor frenzy would burn out? They waited. Loss aversion told them that realizing the loss would be more painful than the anxiety of holding on. And here's the truly insane part. The more they waited, the worse their situation became, because their behavior was completely predictable. The Wall Street bets community knew the hedge funds couldn't close their positions without driving the price even higher. They knew the funds were psychologically trapped, so they kept buying. They held their shares. They posted screenshots of their gains with messages like diamond hands and to the moon. By January 27th, GameStop hit an intraday peak of nearly $500, a stock that had been $17 3 weeks earlier. Melvin Capital Management alone had lost more than 50% of its $8 billion fund value. The firm needed a $2.75 billion bailout from Citadel and Point72 just to stay afloat. Andrew Left from Citron Research, who had publicly mocked GameStop buyers, closed his short position at a huge loss and announced Citron would stop publishing short-selling research entirely. The psychological damage wasn't just financial. It was reputational, professional, existential. Here's what makes this story so psychologically fascinating. These weren't amateurs. Gabe Plotkin had worked at SAG Capital, one of the most successful hedge funds in history. He'd been handpicked by Steve Cohen. His track record was stellar. He had access to the best research, the best analysts, the best risk management systems money could buy. And yet, Robert Cialdini, in his book Influence, talks about commitment and consistency. Once we've made a choice, especially a public one, we feel enormous psychological pressure to remain consistent with that choice, even when evidence suggests we should change course. The hedge funds had publicly announced their shorts. They'd pitched them to their investors. They'd built entire theses around them. Backing down wasn't just expensive. It was admitting they'd been wrong. And in a world where your entire value proposition is being right when others are wrong, that's almost unbearable. And meanwhile, a 20-something named Keith Gill, who posted on Reddit under the name Deep Fucking Value, had turned a $53,000 GameStop investment into $48 million. He wasn't smarter than the hedge fund managers in any traditional sense. He didn't have better financial models. But he had one crucial advantage. He wasn't psychologically trapped by loss aversion, because he'd accepted from the beginning that he might lose everything. He posted his positions publicly. He live-streamed his trades. When people called him crazy, he shrugged. He had no reputation to protect, no investors to answer to, no ego wrapped up in being the smartest person in the room. The institutional investors, by contrast, were playing a completely different psychological game. Every day they didn't close their positions, they were telling themselves a story. The price is irrational. It'll come back down. The fundamentals haven't changed. We just need to wait. But markets can remain irrational longer than you can remain solvent. That's not just a saying. It's a description of what happens when loss aversion meets leverage. The hedge funds weren't just losing their own money. They were losing borrowed money, which meant they faced margin calls, forced liquidations, a complete loss of control. By the time the dust settled in February, various estimates suggested that short sellers had lost more than $20 billion on GameStop alone. Some closed positions at small losses in early January and were fine. Others, paralyzed by the psychological inability to accept defeat, rode their shorts all the way to catastrophe. So what can we learn from a bunch of billionaires losing ungodly amounts of money to a Reddit forum? More than you might think. First, understand that loss aversion affects you every single day, in ways that cost you money. You keep subscriptions you don't use because canceling means admitting you wasted money. You hold on to losing investments because selling means the loss becomes real. You stay in bad business partnerships because leaving means admitting you chose wrong. The key is to separate the decision from your ego. This is what poker players call being pot committed. The fallacy that because you've already put money into the pot, you have to keep going. Professional players know that every decision is independent. The money you've already lost is gone. The only question is whether the next bet makes sense. In business and investing, this means establishing rules before you're emotionally compromised. Decide in advance what loss you're willing to accept. If an investment drops 20%, you sell. No exceptions. No convincing yourself it'll come back. Second, recognize that being right about fundamentals doesn't mean you'll make money. The hedge funds were arguably correct that GameStop was overvalued at $300 a share. The company's underlying business hadn't suddenly become 50 times better. But correctness without timing is just expensive correctness. As the economist John Maynard Keynes supposedly said, the market can remain irrational longer than you can remain solvent. Your job isn't to be right. It's to make decisions that account for both probability and psychology, including your own. Third, and this is crucial, understand that smart people don't lose big money because they're dumb. They lose it because they're smart enough to construct elaborate justifications for why this time is different, why they should hold on, why the numbers will eventually vindicate them. The Wall Street bets traders had a saying during the squeeze. Hold. It stood for hold on for dear life. But ironically, it was the hedge funds who couldn't let go. They held on for dear life to their thesis, their reputation, their need to be proven right. And it cost them everything. Remember the question from the beginning? Why didn't they just close their positions when losses were small? Because loss aversion made a $2 billion loss feel unbearable. So they tried to avoid it and turned it into $20 billion. Because accepting you're wrong at $2 billion means you failed. But losing everything means the market was irrational, your clients were impatient, the system was rigged. It's a better story. It just costs 10 times more. The smartest financial decision you can make isn't about finding the best investment. It's about knowing when you're wrong and having the psychological strength to admit it before the market makes you admit it. That's the difference between a loss you choose and a loss that chooses you. If this video changed how you think about money psychology, subscribe for more behavioral economics breakdowns. And if you want to understand how these same mental traps affect your everyday spending, check out our video on the sunk cost fallacy next.